Guys, welcome back. I'll just give you 2 minutes to settle in, then we continue. Okay. Sorry about that. I really thought you were listening in. So what did we stop? I was saying, okay, that after including all the transactions that you have seen vividly, like with your eyes, okay, you're saying when you add and you find that the total doesn't match the expected, okay, it was A2. It means there's something that happened in between that you're not aware of. And we're saying that's usually cash flow, especially when you don't have it as one of the items here. Okay, but sometimes we do this looking for depreciation. They may tell you acquired new assets of 192, and they will not tell you anything about depreciation. So as you work through, you find that what is missing actually is depreciation, and not cash. In this case, it was cash. Shakira, I think you may want to mute your camera. Okay, so so this is the balancing figure, 192. I hope it's covered. It's a difference between this and that. So you'll see from the others in case you didn't pick this one. So it's a cash flow, is saying we're acquiring assets. So you must have spent money. Okay. And because the spending is an outflow, by the way, every figure that you put here, if it's in brackets, it's an outflow. If it is positive, it's an inflow. Meaning that money came in. Okay. For inflow. Okay, so that's PPE. Let's go to another item. So we're going line by line. So the next item on the list on the balance sheet okay, we find that scrolling. Okay. We have goodwill. Now goodwill, usually whenever there's no movement, then you don't have to do the working. However, if there any information regarding it, they're telling you some few things. You want to do the working. Like for this particular case, they said goodwill. That goodwill arose on the acquisition of unincorporated businesses. Okay, and I guess it was before. Okay, because they didn't see anything more. Okay, so if you did working for goodwill, for example, because there are no transactions hidden or implied. Okay, goodwill. Saying you say that opening balance. Let me now use this since you know what now it is. Balance brought down. You say it's 100. Again, balance carried down. It's also 100. Said you acquired this before. Okay, so meaning that since there was no changes, they couldn't have acquired them this year. So there's no change. So there's nothing like a movement or a cash movement. Okay? So that's how we end up having goodwill as not a working because there's nothing to really prove. Okay. So you got the next item, C, which I think is investment. If they tell you you purchased PPE, you are looking for depreciation. Do you add or subtract? If they tell you that you purchased goodwill, they'll give you this figure 199, but now they want to give you depreciation. Okay. Now, if they don't give you depreciation, then what happens is you'll say there's no depreciation. What happens is, okay, I don't know how I can put it, but emphasize that usually the balancing figure will be a negative because depreciation always reduces the thing. So you find that when you're balancing off, you find here you have a negative. That's how you end up in depreciation. Okay, and usually you want it because you want to use it under P&L. Right? Okay, maybe what I forgot to carry under PPE is the disposal. Okay, disposal. Disposal. I'll come back to investment. We have proceeds. Yeah, proceeds, or you can call them funds. You can call them cash. Yeah, or money. For those who don't like the word proceeds, from the sale or from the disposal, from the sale of the fixed asset or the disposal. The money was given as 110. Okay, it was given. But now you have net book value. You want to confirm, was there a gain or a loss? Because we know that if there's a gain or a loss on disposal, it will be in the P&L. But we also know that the gain or loss on disposal is a non-cash flow. So you're supposed to adjust for it. So therefore, net book value, have it here as 103. So meaning that we had a loss. It's actually a gain. It's a gain disposal 7. Okay, so this one is adjusting. Need to adjust for it by going under P&L. Then this one is supposed to go under investment because you have received money from sale of a long-term asset. Then this reduces your fixed asset. So I had forgotten these values. So you come under your investment. And you say proceeds. I said you can say call it anything. Since personally I know I'm comfortable with the word, you can use it. Proceeds from disposal. PE. Now proceeds, because you received money, it is of course an inflow. Yeah. Then you go to gain on disposal, that's an income. So you come under incomes, adjust all non-cash flow incomes by lessing them. So here you will say gain disposal. It was 7. I don't put brackets because I mean minuses, so I don't forget. Okay. So that is it. You can go back to investment. Investment, was there a movement? Was there a change? Okay, that's the most important thing you first look out for. That when you look at your investment, we are going line by line still. I stopped on goodwill. It's actually development costs. Development costs. You're seeing that there is a change. So there must have been something that we need to look out for. So when you go to your working, C is development cost, not investment. Expenditure. Okay, said begin with the opening balance, brought down. Which is 160. Then you have the balance carried down. The closing balance, which is 290. Okay, so they go and look out for additional information to confirm whether there's anything that you could have missed out or that you need to capture. Then you see if there's any changes that you need to justify. So when you go to your additional information, they said here that well, not one, that during the year which we're looking at, expenditure on development costs or projects totaled 190 expenditure. So we spent 190. Now, if you spend that spending, so that's an outlay, and they didn't tell you that it was on credit or anything like that. So if you want to say it's on credit, you assume it's on cash. So we spent. So we can say additional development costs. Additional development costs or additional expenditure, whatever you want to call it. as long as under development. It is 190. Okay, now because I've said it the way it is, you're supposed to go and show it as your cash flow somewhere. And so in long-term assets, so it is here. Okay, so you come and say we spent, okay, development costs. Say additional development costs or expenditure. Okay, it was 190 and you spent it, so you don't expect it to increase. So it's a minus. Okay, then you're like, okay, it's Kawa. Was there any other information regarding development costs? When you read through, not seeing anything. Okay, so if there's nothing, you must close off the account. It's actually a T account, but just that it is set in a different way, or you're using it differently. So we say, so what do we do? Say balance off this thing. Now in balancing it off, you realize that you have a total of that 350, but you only have 290. So it reduced. So what could be the justification why the figure reduced? Okay, development costs and other intangible assets, we know that either it's impairment or amortization. So here we take amortization. Okay. It's a balancing figure. So the one was asking about PPE in case they gave you a purchase. How do you find depreciation? This is the idea, eh? That you include that you have spent, yes. So what happens if the balance is not the same? Okay, that's change. It will always be negative, and that's the depreciation. So amortization is a non-cash flow, so we come under our operating activities, and then we show that indeed you had amortization. Okay, so it's from working one. C. It is 60. It's an expense. Okay, it is positive because it's an expense, and for an expense we add them back if they're non-cash flow. All right. Okay. Now we continue. Still go back to your statement of financial position. Start from where you stopped. So we stopped on development costs. Okay. Now we're going to cash assets. Cash assets. Current assets. Now for current assets, you know that it's working capital or it's cash and cash equivalent. So whatever you read is what you deal with. So the first thing is inventory. Now we know that inventory is working capital. Okay. Under current assets, anything that's not cash and cash equivalent, it is working capital. Okay, so here our interest is really for working capital, interested in movement, the change. So as you can see here, we're seeing there's an increase in inventory. So you go under your operating activities, operating, because we're not working capital is under operating activities. Okay, where? Even leave space for it. Okay, supposed to have working capital here. In between, after adjusting for non-cash flow, it's supposed to have now changes. Like we already agreed, changes in working capital. We already talked about working capital, referring to current assets and current liabilities, as long as they're not what? Cash equivalents. So we're saying there's an increase in inventory. Okay. Increasing to what? It's increasing to 360 to 77. Taxation. Okay, that is it. So let me answer this question. What do you mean by cash and cash equivalent? Cash and cash equivalents, by definition, I can't really pull out the real definition, but the idea is that anything that is liquid. Okay, by liquid I mean cash that you can, if you go to buy at a shop, give them money, then they pay you, then they give you the product. That's liquid. Anything that is cash or can be used as a mode of payment or medium of payment, that is a cash and cash equivalent. Now, to emphasize the cash equivalent part is any asset that can easily be turned into equity. I mean, into cash or liquid cash in the shortest time possible qualifies to be a cash equivalent. That's why we're saying short-term investments qualify, especially you've heard of what do you call them? Government what? The script. Okay. But there are those items, they're financial instruments, yes, but they can easily be transformed into cash. Okay. Then those become cash and cash equivalents. Okay. So, but for now, just know that it's either cash at hand, cash at bank, or short-term investments. That is cash and cash equivalents. Okay, so we go back to where we are. So we're saying this 360 minus 227. Okay, now increase in a current asset, it is an outflow. Okay, why? Because either you spent on the goods, okay, spent on the goods, and therefore that's why they're increasing. Or alternatively, what would you say? Or you decided not to sell. Okay, so if you don't sell, you're holding cash at our premises. It's not good. It's not good to hold cash. You must use it for something. So that is the idea. But the easy part is just say, for inventory to increase, you must have spent on it. You may either manufactured more or you bought more. And because of that, it's an outflow. All right. So that is clear. I hope so. Then we go to receivables or debtors. This one's reduced. So you said decrease trade receivable. Okay, it decreased from 324 to 274. Okay, that was our decrease. So the reverse is true. So just master one thing, or you, how can I put it? One explanation can help you on the others. You don't have to think again. But for those who like thinking, I'm saying for receivables or debtors, these are people to whom you sell goods and credit. Okay, so if they are reducing, if the balance is reducing, it can only mean that they're paying you back. That's why the money is reducing. Okay, that's the idea. Although you can have X of bad debts in there and then you write them off and stuff. Okay, but the idea is that if your debtors are reducing, then they're paying you. If they're paying you, then you have an inflow. Okay, so that is it about that. Then we continue. Then you have investment. So when you see investment, those are cash equivalents, especially if they're under current assets. So you go to our small thing that I've done here. It's actually working number 4 in your class. The class notes. It's working number 4 somewhere like that. Okay, so we're saying you're supposed to have opening balances. Saying you have opening balance, all the balance brought down. Then you have balance carried down. Okay, so I can see the investments. The opening balance of investment, you have it as 46. And then closing balance for investment, we have it as 143. Okay, that is it. Then you continue. So you see the idea that if you know where something falls, it's really Nothing much to think about. Then the next one is cash, which is a cash and cash equivalent. Opening balance is 117, and the closing balance is 29. Okay. It's the bank overdraft, sorry, it's cash. It should be up there. Okay. I'm sharing my screen. Don't. Okay. Then we continue. Then you go to equity. Okay. Once you hear equity, you just know this is financing. This is financing. Okay. So we had the share ordinary shares. Whenever you have ordinary shares and share premium, always you advise to have one account, combine them. So let's see. Now officially I've gone into another set of items. So it's working number 2. Looking at equity. So part A, saying it is share capital. Share premium. Account, it is 1. I've combined it. Okay. So we begin as usual with the opening balance. Opening balance, let's go down. So they're combined, I'll just add them together. We have 400 for share capital. Then you have share premium, you have 100. So this will give me 500 at the beginning. So I know that in case of inactivities, I will just adjust for them, but closing balance, as for sure,
Whatever's your screen.
500. Okay. Sorry about that. So I'm saying closing balance is 500. And then share premium is 350. Okay, giving me 850. Okay, these ones are from the balance sheet, so there's nothing to worry about. Okay, so we'll now go and see, is there any information that we have that can help us do a few things here and there? Okay, so if you go to your additional information, we said a few things about shares and stuff like that. When you scroll through and here, and the last part, saying that during the year, Dixon made a 1-for-8 bonus issue, capitalizing its retained earnings, followed by a rights issue. Okay, so the bonus issue, that means it involves the retained earnings and the share capital, because we know that a bonus issue has nothing to do with cash. Okay, it's a bonus issue. So having said that, we're going to confirm what you can do with this. Okay, maybe it also emphasizes both bonus issue and rights issue, they involve existing shareholders. They're the beneficiaries of this. Okay, so let's look at the bonus issue. Bonus issue. So our focus is basically on the ratio is 1:8 or 1/8. Okay, our emphasis is on existing shareholders. Who are the existing shareholders at before this whole issue? So there you look at the opening balance, but of share capital only. Okay, so we're saying if it's the number of shares, it is actually the first value that you have, or the book value of the shares, and then you divide it by the par value of each share, or the value of each share. Okay. And we're given the first value as 400, okay, 1,000 of course. Then, but the par value is only 1, or it was $1, so giving us 400 shares. Okay. So if that's the case, then we're saying now the bonus issue, how much more shares do we issue? think it's 1/8, one for every 8 held, but we held 400. So meaning that the bonus issue that we made was 50 shares. Then we're like, but what's the value? The value is that for each is for each value, it's at the par value at 1. Okay. Each is at $1, like the one we had here at par value. So meaning that our bonus shares in terms of dollars, how much you actually share? It is the 50 times 1, giving us $50. Okay. So, and we're aware that for bonus issue, like we already said, supposed to debit retained earnings, not bank or cash, because you're not receiving any money from shareholders. So, but what you're sure of is that the share capital will increase. That's the credit. And to reflect these transactions, we shall come under share capital and say we had a bonus issue. You can say bonus issue, or you can say that other account that is involved, which is retained earnings. You bring it here. It increased our shares by 50. Okay, so don't forget that under retained earnings, if you're doing the retained earnings working, you must have the bonus issue, 50. Okay, so we continue. Then they also talked of the rights issue. Okay, they talked of the rights issue, but do you know the rights issue? We don't know. They didn't give us any information that is serious that can help us compute the amount. Okay, they say that, and followed by a rights issue. So that can only just mean that if there's any movement or changes in share capital, that was a rights issue. Okay, but the beauty is that a rights issue involves money. It may be constant that we use existing shareholders, but we also know that we receive some money. Okay, so therefore, this will give me a total of that. So I'm like, there's a difference still. Now this difference is what you're calling it a rights issue. And as a matter of fact, you're seeing they're going to increase. So if capital increases, it means that we issued more shares. Okay, you're seeing it's increasing by 300. Now this is what you call rights issue. Now rights issue, like I already said, it's a cash flow item. So we know that we increased our cash flows by 300 because of issuing of shares, under financing, because it is equity item. So you come under financing, therefore, and you say proceeds. Say the proceeds, or you can say money or funds from the rights issue. Okay, it was 300, and it's money received, so 300 positive. Okay, I hope we're together. Then we go to the next item in the line. Just move line by line. Okay, so the next item in the line, which is balance sheet. Okay, share capital is done. Share premium was combined with share capital, so you have now revaluation surplus. So you go to revaluation surplus. Still, as you can see, there's a movement, there's change. So because there's a change, saying it needs a working part B, valuation surplus. Okay, so you begin thinking, that's my opening balance. You think of item that affects valuation reserve, things like valuation gain, things like transfer if there was, things like depreciation, yeah, all those affect valuation. Not directly for depreciation, but it does. Okay. So we're saying what is the opening balance? Surplus is 60. and the closing balance is 152. Okay, so like opening balance carried down. All right, it is fine. So what next? So the next thing is, are there transactions that occurred in between? So we already saw gain on revaluation from the P&L. Okay, gain revaluation from the statement of comprehensive incomes, 100 that we took under PPE. Okay, it comes here. Then what else? Like, did they give us any other information regarding evaluation surplus? When you check your additional information, I don't think there is. Because nothing was said, indeed. So if nothing was said, you're saying, okay, now you close off the account and you tell us, is it okay, or is something that we had to find out? Okay. So in doing so, add this. Okay. That's what I have. But they're not the same. So meaning there's an activity that you don't know about, which is a negative. It's a negative 8. I think I put my bar somewhere wrong. Put the bar this side. Okay. So we're saying, what could this be? What can only be this? Okay, we're saying things that reduce revaluation surplus. It's either how would it be? I think it's only strictly transfer depreciation, transfer to something else. Okay. And usually it arises on depreciation. Whenever you have an asset that has been revalued before, and then you are depreciating it, there may be a policy of the company to transfer the extra depreciation to the P&L. Okay. So that is it. So it's a transfer to retained earnings. But this is a balancing figure. It wasn't there, but they just computed it. You realize it's not a cash flow, so don't rush to take the cash flows. Why did you combine share capital and share premium? We usually combine them. That's the policy or the way we do cash flows. And the reason is because share premium won't increase if you didn't issue shares. Okay. And because of that one account depends on the other. That's why you end up combining them. Okay, you want to have a scenario where you have share capital reducing. I mean share premium. For example, reducing when share capital is not reduced. Okay. That may under bonus issue, but the scenario where share capital increases and then share premium remains the same, it's also possible, but share premium increasing without share capital being affected, so rare. Okay, share premium arises when we issue shares at a premium, okay, more than the par value. So because of that fact,